welcome to episode 25 of Top of Mind with Consilio Wealth. It is June 2nd, 9:50 in the morning, and we are fresh off the news that the debt ceiling was suspended until January 1st, 2025. This passed the House and then later the Senate late last night. We'll get into some of the nuances of this bill, but I suppose the good news, or at least the relief, is that the debt ceiling was suspended. On today's episode, we will also talk about the state of the economy from the lens of the typical American. There's just some interesting data showing up with spending, credit card debt, money in the bank, that sort of thing. And finally, also released today, it was a super strong jobs report. Maybe that's good news, maybe that's bad news, and we'll get into that as well. I'm joined as always by my friend and colleague, Hao Dang. Hao, welcome to the pod.
Thanks, Chris. Good seeing you.
Good seeing you. Good seeing you. Let's dive in. So, debt ceiling, what's in this deal and what's notable that we should share with our listeners here?
I'll get right to it. What's notable is the lack of headlines, the lack of positive headlines. CNN, I'm calling you, and
Yahoo
CNBC,
Finance, I'm calling you.
Yahoo Finance, and Reuters. Some reputable. Again, if you're listening, I'm using air quotes. On video, I am actually air quoting. And lack of news. And leading up to this, plenty of news. The economy's going to crash. We're going to miss Medicare and Social Security payments. Yeah, true, if the debt ceiling wasn't lifted. And the fact that this garnered a lot of political attention, it's probably shame on Congress as well. And I think it drove a lot of unnecessary headache and sucked a lot of air out of the room, which, again, if I'm CNN, I need to sell clicks, but I don't know. There's got to be a better way to do this.
So we have a thread within our team that we send articles back and forth and whatnot. And so, as soon as this deal was announced, I got a ping on my phone from Wall Street Journal and Barron's, and I believe Bloomberg as well, all immediately. Read the article, fired it out to the team. And so, literally 3 minutes ago, as we were just about to hit record, Hao and I were chatting. Okay, so what's in the bill? We should get some notes in here. Couldn't find anything. Not top of news. Had to dig. It took us maybe a minute to actually find what was in the bill so that we can actually highlight it for you all today. So that's just an example of how I guess this is old news already, and we're looking past it.
Or more calling out these news media headlines is it was self-generated news. Mm-hmm. It was more of a story than it was. Again, you didn't see any panic from us. We did address we're going to address some of the psychology leading up to this, because I'm pretty sure a lot of people went to cash because of headlines.
Yeah, and our objective here is not to downplay the seriousness of the debt ceiling or what could have happened, but as mentioned on our prior podcast and our quarterly market commentary that'll be released here soon, the debt ceiling has been raised or suspended more than 100 times since World War II. This is a common thing. This happens all the time, and it was likely that it was going to get resolved, and here we are, and it did.
Yeah, and a little bit of following the money, right? Because these politicians have donors and own stock themselves, and they don't want to lose out too.
Yep. Yeah, totally. So what was the top headline then today?
Jobs numbers. It was stronger, and the implication there is the economy is overheating, and we need to raise rates to, I guess, lessen the heat. I don't know about the cool down the economy, but yeah, the back burner suddenly was the debt ceiling headline.
We'll come back to jobs here in a minute. We'll stay on the debt ceiling here for just a quick recap. So, of note in the bill, student loan payments are going to start back up here soon. Actually, as planned, but it was confirmed in the bill that they will start back up. So, everybody's been in deferral, and now we're going to have to start paying that. That actually helps the national debt. So that was one of the items that reduced government spending year over year, is projected to reduce government spending year over year. There was $28 billion of unused COVID funds. Those were rescinded. Essentially, there was just a bank account with money that was authorized that hadn't been used yet, and so that was pulled back. There was additional money for vaccine funding, and then also there was a cap in military spending increases at 3%. Other than that, there really wasn't much in the bill. There's a quote here that says, is the first time year over year that the government will spend less money. So they'll spend less money here in the coming year than they did in the last year. That's probably good news. We all know that there's a federal deficit, but nothing really else of note.
No, it's more self-generated drama, politicking. Because why huff and puff over what essentially amounts to less than 1% of the federal budget? It's probably less than 0.1% of the federal budget if we broke down the percentages. Because $28 billion sounds like a lot in absolute terms, but $28 billion on a multi-trillion-dollar budget is very small.
Yeah, totally. So we made a bold call this last podcast that we recorded. This was on May 17th that we recorded our last podcast. And we said that we thought that the market could react positively to a deal on the debt ceiling or react negatively to of course, a default, but just a delayed deal. We said that we thought that the market could go up anywhere from 0 to 5% on the good news. We said that we thought that the market could go down anywhere from 5 to 15% on bad news or delayed news. That was just our thinking. We looked this up here this morning. As of May 17th to today, how far is the market up? And by market, I mean S&P. So where are we at right now?
From the 17th, we are up 1.5 through yesterday.
1.5%. It's wild because
up 1% when we started recording, I think. So
it's wild because
2.5.
It feels like the market's up like 7% since that day. Because this week has been just up with all the pending potential good news, right? But of course, things had come down before. And so I thought we would just mention that because, again, this is from 517 to 6.2. Market's up a whopping 1.5%. Great over a couple of weeks. But again, within range of that 0 to 5. So anyway, priced in.
Yeah. Whatever you read on CNN or Fox News, and you're using investment advice off that or an investment thesis off that, you're working off really stale information. Mm-hmm. And the market has already priced it in, probably at the beginning of the year, because it wasn't a secret that the debt ceiling was going to be coming to a head in January, right? Treasury Yellen said January 19th, hey, we're going to have to take extraordinary measures to start paying our debt. So she shuffled money for the last 6 months. Mm-hmm. And if you're looking at news headlines in May to make an investment decision about something that's already happening, good luck to you. That's a very poor investment approach.
Yeah, there was a post that said that the feds were ready to auction something like 15 billion of securities that were due in one day. So they literally just needed 15 billion in the bank to pay some bills, and then they're going to pay them back the following day. But now with the debt ceiling, and that was it's kind of extraordinary measures of, hey, we're bumping up against the debt ceiling. We can't do big amounts. And now with the passage of this, they're looking to issue about 125 billion in the coming week, which then sort of refills the bank for a little bit longer. So again, just interesting, right? But you're talking about a one-day loan. I can't believe we even have this rule. So anyway.
Yeah, well, it gives the newspapers something to sell.
So let's talk about that. So
Yeah.
there will always be reasons to
always
not invest. We tend to highlight a lot of those because part of the purpose of our podcast and content is really to try to digest to the top of the media and hopefully bring to you all what we think is a real answer to that, because we can, again, hopefully cut through the noise and the clicks there and bring our unfiltered opinions. So Hao, you've got some thoughts on this here, but I just want to let you kind of explain to our listeners on on what you're thinking on all the reasons on not to invest and why people should just stay invested, stick to the plan.
Yeah. And to be blunt, the market doesn't care about your opinion of where it should be going or how it's valued. If it's too cheap, too expensive, it does not care about any single one one's opinion. And I've learned that personally the hard way, where it's like, hey, this stock is oversold or overbought, right? And we've all done that. And I'm speaking to essentially my younger self who thought I was smarter than the market. And I think that's really important to recognize to make yourself a better investor in the future. Is the market is going to price in what it's going to price in.
Mm-hmm.
Whether you think it's right or wrong, especially if you think it's wrong, it could be wrong for a lot longer than you're solving. And that's a pretty well-known term, right? Like short sellers could be right, but it's a matter of time. And if they're right a year early, they're out of business, right? Yeah. That's a big difference between a year early and a day early. So if you're going to nail the bottom, which if you were making an investment thesis on the debt ceiling not being resolved, or we resolved it 3 days in advance, which is, I thought they would milk this for another 3 days.
Yeah, me too.
Giving more people reasons to worry, right?
You know what, though? I also thought that there was a little wink, wink, nod, nod behind the scenes saying, hey, let's get a deal done swiftly and early because we need to show that politics is working in the U.S. There's been some recent reports that politics and democracy in the U.S. has been not working as well. And I feel like this was sort of a turn off the recorders, hey, everyone, let's make a deal so that we can prove that we're still functioning. I have no facts around that, but that's just my thought. Yeah.
Or their donors or their own portfolios are saying, hey, we need a bit of a break here and let's throw us a bone. And I think money does drive, interest does drive, right, some of these decisions, whether to resolve something sooner. In 2011, ultimately, we did not default. We did miss the deadline, but I'm pretty sure a lot of people benefited from that relatively temporary pullback.
Well, and I think our point here is that if you are expecting trouble or you're expecting bad news, all you're going to read is articles that continue to confirm that news. And so our advice is watch your confirmation bias here. The media is great at stoking that fire. But the challenge is to read that and say, yeah, but what if that doesn't happen? Which is our job, right, with our clients' money. But again, we would challenge all of our listeners to really try to not stoke their confirmation bias just by continuing to read more and more articles that say the same exact thing.
Yeah, we got inquiries, right, about whether we should move to cash.
No one did, but that's good.
Yeah, and for our part, we do welcome outside opinion or contradicting opinion, because that's part of what makes us better, because we fall to the confirmation bias trap sometimes too, right? And I think if you listen to us over time, we're a little bit overly optimistic. But at this point, if you invested all that time during 2022, during the bottom of the summer and the bottom of October, you're pretty well off in such a short period of time. But our main theme has always been get invested, stay invested.
The challenge with going to cash, and that's an extreme, so go to cash is one, or just selling one thing and going to another thing, selling value going to growth, or selling small companies and going to big companies, or whatever it is when. There's two sides to that trade. And so let me just focus on going to cash. If you do decide to go to cash, you have to decide when to sell. And then the hardest part is deciding when to get back in.
Yeah.
And that gets harder both ways, or either way that the market could go.
Consistently.
If you sell and you get your money back and the market goes up, you're likely thinking, I gotta wait for it to go down, which may or may not happen. It might not go below your exit price. If the market goes down, you're thinking the same thing, but on the opposite. It's going to keep going. I knew it. It's going to keep going. I knew it. It's hard to get back in.
Yeah.
And so that is the greatest challenge. Selling, I would argue, is the easy part. The media helps you sell. Buying is the hard part. The market seemed to bottom on October 15th last year. It's largely gone up or the right direction since then. There was zero news on that day. No news right before, no news right after, no good news at least. No reason. but ultimately things decided to start going the other direction.
Yeah, and I think if you are making those trading decisions, you're adding a lot of undue stress, especially if you're a long-term investor.
Yeah.
And you're playing dictated that. I think the decision not made should be as impactful as the decision to sell, right? Because you feel better that you did something, right? Versus sitting on your hands and doing nothing, which is probably the best thing to do all year, because you did capture at least some or all of at least the S&P run up, right?
There's a quote here from Morgan Housel, and if you don't know Morgan Housel, he wrote a book called The Psychology of Money. Fantastic book that we would strongly recommend to our listeners.
Recommend.
Excellent book, easy read.
He's in Seattle too.
He's a local cat. I'm hoping to run into him someday. He wrote a blog post here recently, and we just wanted to pull one quote about it. And he said, when looking at articles and short-term economic data, ask yourself, will I care about this in a year? And I think that's really good perspective, because there's so many things that are in the media that we could all remember that we read a month ago, 6 months ago, a year ago, 2 years ago, that now we don't really care about. The learnings, though, say from books or from experiences in life or those types of things, those are the things that really imprint on our lives over time. Those are the things we do care about a year from today. Yeah. So that would be our message, is when you're reading articles, posts, when you're stoking your confirmation bias, ask yourself, will I care about this in a year?
Yeah, and we're typically here as advisors, as a sounding board, right? That's important for clients to prevent that big mistake. Because where are you going to make up 11% gain anywhere in the market, unless the market gives it back to you?
Yeah.
So now you're in a position where your fingers are crossed to get another debt ceiling drama or something else to give the market a reason to sell off.
Yeah.
And this is 2020 all over again, right? Where everyone was saying, hey, it's a double dip recession. We're going to have another big sell-off in the summer of 2020. We didn't get one until November of that year. So you were on the sidelines for 7 months and a 50% run-up in the market. Good luck making that up.
Yeah. Tough to call.
Yeah,
Tough to call.
And you never get yesterday's price, because no one's going to give you yesterday's price. They're going to give you the price today. And it's up to you to decide for the future whether you can withstand the risk, because there's always going to be risk in investing. Yep. And that's what scares the I guess the typical person. I know we try to avoid the term average, but the typical person will be scared off when there's any sign of volatility, which gives opportunity to long-term investors.
I want to switch gears here a little bit. So, yes, we've been overly positive. Yes, markets generally go up. Yes, we believe in diversification. That's how we can build that thesis. I want to switch gears a little bit here and talk about the state of the economy from the lens of the typical American. So there is some interesting news here. Not news. There's some interesting data on credit card balances, personal savings rates. Potentially, it's pointing to a lot of people in America are running out of money, and that's not necessarily great. So we thought we would talk through this. Those of you who are tuning in on YouTube, you should be able to see this chart on your screen.
We'll
so. Also do our best to describe it if you are listening while you're walking down the street or driving your car.
Yeah, I think this is the first time we're sharing a chart live here, Chris. So
the debut.
Yeah.
All right. What are we looking at here, Hal?
We're looking at three of the big things that you mentioned. Recently, the headlines have been saying credit card debt reaches an all-time high. We're also looking at the personal savings rate. And the last one is a little bit inside baseball. It's called the M1 money supply. You've heard us mention M2 money supply. M1 is a little bit more the liquid version of it, or the paper currency in circulation along with checking and savings. Like really accessible.
Cash in the bank. Checking and savings.
Money to be spent.
Yep.
All right. So what we're seeing is those three lines on the one chart.
And this is a 10-year historical chart.
Yeah, going back 10 years. Let's look at U.S. credit card debt. That that has gotten a lot of attention, and it should. I think credit cards are one of the most egregious ways of carrying interest and having to pay that. So it does deservedly get a lot of headline attention. And if you look at the trend prior to the COVID lockdowns, it was running at a really healthy clip, meaning the line was going up, what we call a trend line. And the trend broke when COVID hit because no one was spending. They were locked down. But then we had this jump from starting in the summer of 2021, when things started to reopen slowly but surely. But if you get rid of that dip or the little trough there, the trend's still on trend. It's normalized. But what you'll see in headlines is credit card growth has grown at historically fast rates. Well, if you're taking a historically low point and you're comparing it to a historically high point, you're going to get a big dispersion there. And to the naked eye, that looks like we are increasing our spending at a really rapid rate. But you get rid of that trough, as I mentioned, it's back on trend. Because we probably would have gotten there without a lockdown anyway.
Yeah. So what's interesting here, my takeaway, so the M1 money supply, which again is essentially checking and savings balances in the country. It was slowly upticking through many, many years. That makes sense. More people, more bank accounts, more money in those bank accounts, regardless of the balances. And then COVID happened. So the lockdown of COVID happened, and not only did the personal savings rate skyrocket, the money in the bank skyrocketed. That's due to all the stimulus. So the stimulus payments were thought to be exactly the word, go give you money and go spend it and stimulate the economy. And actually that didn't happen, at least not initially. That money just sat in the bank.
Yeah, what are you going to spend on?
Well, that's true too. Amazon packages, I think.
Yeah.
And maybe Netflix. So the money got stacked in the bank. The other thing that people did that was interesting is they started paying down debt. That's actually good. But credit card balances went down by 25 to 30% in 2020. And so they used economic stimulus. They actually paid down debt balances. They saved money in their banks, and they didn't really spend a whole lot. And then that trend started to reverse. And in 2021 or so, that's when spending really started once again. And I think that's what's impressed all of us and what's really propped up the economy. U.S. consumer spending is about 70% of GDP, meaning if people stop buying things, we likely fall to recession. We have to have the money circulating and people buying things, restaurants, planes, cars, all this stuff, in order for the economy to stay healthy. And that's been incredibly strong. Now what we're seeing, though, is that the personal savings rate has gone through its previous floor. So that's the bad news, is that people aren't saving nearly as much as they were pre-pandemic. In fact, we're hovering around 4% right now, which is not an all-time low. It's been negative before, but it is a low. Credit card debt, yes, is at an all-time high. Those statistics to me are, there's kind of always more people. There's more credit cards. There's more things getting bought.
There's inflation. Things are
it's like the same thing when CNBC is like, the Dow's down 1,000 points. It's never gone down that many points before. Well, of course, because it's never been this high before. Like, those are the statistics to me that don't make any sense. You got to quote percentages, not points. Anyway, and then the M1 money supply we're seeing now since about mid 2022 has been coming down. So in sum, people have now less money in the bank, they have more credit card debt, and they aren't saving as much. That's kind of a not great recipe. So that's kind of what we're seeing here, and what could ultimately lead to a dip in future spending. That's probably why CEO surveys and business surveys are preparing for recession. How you had some interesting news on hiring and how most businesses feel we're likely to go into recession, but yet they're still hiring. Let's unpack that a little bit.
Yeah, our jobs number came in pretty strong, and that was the headline today, not the debt ceiling limit. And with the jobs numbers coming strong is that gives the Fed more reason to raise rates to slow down the economy, right? So you got more jobs, more spending, hence more inflation or more expected inflation because people won't stop going to Disneyland or restaurants. The Fed will see this blowout jobs number in terms of how many jobs were created in the last month, which we beat by quite a few thousand jobs, like
wide
by
margin.
a big wide margin. A couple of things though too that if you're looking at beyond the headline is the unemployment rate went from 3.4% to 3.7%, and we added jobs. So how do we get more unemployed when we added so many jobs relative to what we were expecting? Well, more people joined the workforce, and I'm more apt to think that it's people who thought they retired in the last year came back, either through the lack of savings or the inability to pay higher prices relative to inflation, or their portfolio performance not doing as well as they would hope in the last year. And this is a struggle for recent retirees who are not quite ready to adapt to the non-working life. So boredom might be a part of it too. So there's this confluence of people probably aging into the workforce, like anyone 16 and older, but also people boomeranging back to the workforce. And that caused a pretty nice uptick in unemployment.
So let me just give some numbers here. So the median forecast as surveyed from economists from Bloomberg was for $195,000 jobs increase. It was 339,000. So it blew it out of the water. This is May. To give you an idea, in April, the U.S. economy generated or created 294,000 jobs. So 294,000 in April, 339,000 in May. Average hourly earnings are still growing, 4.4% in May, 4.4% in April, 4.3% in May. That's good. So wages are still growing. And to Hao's point, the change in labor force was the biggest change here. So in April, the change in labor force was minus 43,000. So 43,000 people left the labor force. They stopped looking for jobs, so they're not calculated in the unemployment rate anymore. In May, 175,000 people entered the labor force. And so that's likely why the unemployment rate went from 3.4 in April to 3.7 in May.
And we might see another ripple effect from that as graduation season is wrapping up. So what do new graduates want to do? They want to go work. And I think we'll see a bit of a seasonality shift there too as well, with summer jobs and summer internships picking up. But I think it's a mix. It was a mixed jobs report. It wasn't the stomach churning inducing headlines that we've seen is, the economy is running too hot and it's adding too many jobs and therefore people are going to spend too much, which it could be a good cycle, right? And employed people keep the economy going. And whether the Fed needs to slow that down for fear of inflation, which, when's the last time we talked about inflation? It feels like decades ago. And I think it's a lot of, we especially with jobs numbers, you have to let some of the lags go through the system first before you have to see what kind of impact it has. And the odds of a Fed hike in 2 weeks actually dropped. It was nearly a 60-40, 60% being 25 basis point hike versus 40 no hike. Now it's 60% or 66% no hike, 33% odds of a hike. So the futures market is not pricing in increasing odds of a rate increase in 2 weeks.
Interesting. So I want to highlight something interesting from this job report. So 78% of the job growth came from the top 4 sectors or top 4 industries. That's private education and healthcare, almost 100,000 jobs added there. Professional and business service, almost 65,000 added there. Education and healthcare, 56,000, and leisure and hospitality, almost 50,000. And so those four sectors accounted for 78% of job creation. Bottom five, information services. Okay, that's tech, but only a minus 9,000. So yeah, there's been a lot of layoffs, but there's still companies that are hiring elsewhere, or in other industries that maybe aren't making the news as much, or rather in other companies. Manufacturing lost 2,000 jobs, utilities gained 100, and wholesale trade gained 1,100. So really, there's only 11,000 jobs that were lost in this last month. It was fully creation. So again, this is very good news. I actually think it's good news that unemployment ticked up. That's been something that the Fed's been looking for. That's probably why the odds came down for the rate hike. And inflation, as we know, continues to trend down. So I actually think this job report is good news because of all of that.
Yeah, but the headline says we're hiring too many people, right?
Yeah, so this quote here, this is interesting. This is an article here, and there's a person from ZipRecruiter being quoted. And it says, with demand for goods and services holding up, employers who have been cautious and even very nervous about overhiring when push comes to shove have to keep hiring just to keep pace with business activity. Business owners are very worried about a recession later this year, but they need to keep hiring to provide the pizzas that people are demanding to prevent flights being canceled. Interesting position, right? Yep. You're trying to save money and not hire people, but the demand just is there. You have to hire more people.
Yeah, and I think to add to that, the struggles of the last year of being understaffed if you're a restaurant are really still stuck in your mind, where you've had potential customers walk away because they didn't want to wait, right? Even though you had half the restaurant still empty, right? You just didn't have enough staff.
Yep.
And I think a bit of that staff hoarding is coming into play, where, that PTSD, I guess, with being understaffed or, not sufficiently providing for your customers is still stuck in a lot of small business owners' minds.
Well, good news. About 50,000 jobs were added in leisure and hospitality this last month, so hopefully that pinch starts to go away there a little bit. That's like 25% of the jobs that were added, so hopefully that's a good trend.
I think that's an industry that we'll continue to see. I've seen, a burger flipper at McDonald's makes more at working at McDonald's than an engineer in some country, right? And I don't know. I think perception needs to change there, because in terms of productivity, that worker at McDonald's actually generates a lot of revenue for the company.
No kidding. Yeah.
So if you're facing the threat of AI because all you do is spreadsheet work, that it's you have to look at it from a productivity standpoint, because corporations are always looking for profit and how much they can extract from their employees.
And productivity is a big metric.
Yeah, and yeah, we can dig at burger flippers all we want, but I think they generate a ton of money because they turn a lot of. Look at a McDonald's drive-thru. They're still pretty busy. Yeah.
Look at a Chick-fil-A drive-thru, but that's another story. I just read that there was the first fully automated McDonald's that opened up. So this is in test. They're trying to figure out, can we have no employees, basically just people delivering the stuff, and then it's fully automated? I think the $1 million question there is all that automation cheaper than hiring the person at $20 an hour and paying them to be there? So remains to be seen. In typical tech world, costs drive down over time, and then you start to have this curve that comes up. So that'll be interesting to see play out as a lot of these restaurants and fast food chains sort of convert or try to bring in sort of this automation element to try to reduce wages. All right, that's all the time we have today. Thanks everyone for tuning in, and we'll talk to you again in 2 weeks.